About 6 weeks ago, the JSE, together with 2-3 other sponsoring companies, including National Treasury, by the way, took a team of some of the top 40 CEOs listed on the JSE, top 40 companies listed on the JSE, to New York. Now, this was the second iteration of this investment conference that we run as a JSE called South Africa Tomorrow. And we schedule it alongside the IMF World Bank meetings so that we can also have senior policymakers come and join the meeting. And this particular time, we had our brand new Minister of Finance, Nene, come and join. We also had one of the deputy governors come and speak. Now, we were able to attract, I think we had maybe 10, maybe 15 top CEOs at this meeting. We were able to attract maybe 100 investment houses based in the Northeast, primarily New York and Boston. And I would estimate that in the room, we had over $1 trillion of invested funds represented by one person or another. Now, this was fresh out of Nkandla and mayhem and the Commission on Marikana and aftermath of the strike. So you would start to think, well, South Africa going out there to try and sell South Africa is a mug's game, but it isn't. So I asked one of the fund managers from one of the particularly big houses that still invest in this country, as well as other emerging markets around the world, what it is about South Africa that kept us on their radar and that kept money here. And they said, frankly, and with all respect to our government, they said, frankly, your government is a bit of a basket case at the moment. We don't pay any attention much to what's happening in the politics, so maybe this time it's the economics that eats the politics. But they said, we go beyond that and look at the quality of your private sector management, and it's simply some of the best in the world. We do not often go to a country of the size and maturity of South Africa and find a private sector that's quite so mature, that's quite so good, just technically capable, that's so governance focused, and that's so ethical. Remember, these are people who invest in Russia, et cetera, et cetera. I don't mean to be disparaging against anyone, but I'm just saying. So when we compare, like for like, actually we compare rather well. And so we will continue to attract funds flow, perhaps not FDI, because FDI, then the politics start to eat up a little bit of the space of the economics because somebody puts up a beachhead here. But certainly from a JSE perspective, we have not seen a pullback in investments in South African portfolio stocks, either on equities or bonds. And if you look at net sales of our equities this year, it's roughly in the same ballpark as 2013. So the story, when you just come out of South Africa and look at ourselves from an external environment, doesn't look quite as dire as it sometimes looks when you're so focused on what we look like without comparing with what we look like out there. Now, the nightmare scenario for commodities players is China, actually. It is a China that is slowing down. Because even if you don't ultimately sell your output to China, and Ichor Coal certainly doesn't, it still determines the global demand and supply dynamics in your industry, in our industry certainly, and that's across the board. It also determines price, because that ultimately is what it's all about. So having gone into 2014 with a South African economy that was touted to grow at 3.5%, as Adrian said, but China also continuing to grow, albeit at a slower pace, the news coming out of China has been a shocker. And what you've seen in resources has really been a reflection of how surprised we've been by the deterioration in the growth dynamics of China. So halfway through the year, I think 2014, we consoled ourselves that even as China's growth slows, the pace of growth slows, it's still a really, really big economy, and the absolute level of offtake of our iron ore, et cetera, remains quite large. Now, as we go into 2015, there's some voices out there that are beginning to say, what if the absolute offtake drops? What actually if China starts to take less in absolute terms of all of these raw materials that we produce, because like it or not, in South Africa, we still need our resources sector to pump up demand. It gets this multiply effect further downstream. We think we do have a large services economy, but it needs to feed off something. It doesn't have an existence outside of our manufacturing and mining sectors. So for us, the nightmare scenario for 2015 is a China that begins to misfire. As much as we may like or not like China, we like very much the color of their money. So that's the first one. The second one is it's perhaps not quite as much to the fore at the beginning of 2014 that has to be arresting CEOs in the mining sector is labor. So if there was a time when the business sector thought they could do their own thing and not mind much else in terms of other social partners, well, 2014 brought us up short. And the fact that labor has something to say about a wide variety of things, not only on the shop floor, but in terms of how people live outside of that, and that it has to be the business sector that also worries about those things, really did bring us up short. And how we respond to that is going to be a very, very interesting thing to watch in 2015. Now, if we circle back to the conference that I spoke about, that was the one big ticket item that absolutely everybody wanted to hear from the CEOs about. What are you going to do to cool down the temperature in the labor sector? Just interestingly, the CEO of Anglo-Plat was in the room and took a seat at a podium like this to answer those questions. And I have to say, I take off my hat to just how the CEOs in the mining sector handled candidly the questions from the audience and demonstrated an insight into the root causes and the thinking that is beginning to propagate through the sector about how one may go around tackling all of these issues. Now, if you look at what's happened just recently in the trade union movement, you take one of two views. You take a view that, oh, well, wonderful, COSATU is in disarray, they're not going to be focusing outward at all. It will all be about the power shifts that we're beginning to see happening at federation level, certainly. And so we may have an easier time of it. That's one view. It may happen. We saw that in the political sphere, that you do get paralysis where there's a power shift and the new power dynamics are not yet in place. And we certainly saw that post-Polokwane at national level. Will that happen in the trade union movement? Who knows? It's going to be a very, very interesting space to watch. The diametrically opposed view says, well, in this vying for new members and new unions being formed, to compete with traditional unions, you start to see a rise in militancy because everybody wants to demonstrate that they can extract the concessions from employers that workers want. And that is the story of AMCU. And we saw what can happen to a sector when that sort of competition starts to take place. So that is a second nightmare scenario for the mining sector. We saw the turmoil in platinum in 2014. Where is it going to go next? Is gold going to be the next arena where this plays out? Is coal going to be the next arena where this plays out? So those are two really big ticket items in our sector that are really actually arresting the mind and don't have easy answers, and you should really not play a predictive game rather than just play on scenarios and how you might take a stance vis-a-vis those.